OCBC and UOB have just reported their second quarter 2026 results. And while both Singapore banks delivered higher profits, investors reacted very differently to the two stocks. OCBC surged to a new record high, while UOB shares moved lower. So what happened? And more importantly, where could OCBC and UOB shares go from here? Let's take a closer look. OCBC reported a record second quarter net profit of 2.22 billion Singapore dollars. That was a 22% increase compared with the same period last year. It also beat the average analyst estimate of around $1.93 billion. The main driver was strong growth in non-interest income. OCBC's non-interest income jumped 51% to $1.91 billion. Fee income increased 28%. Trading income surged 85%, and insurance income increased 68%. Wealth management was particularly important. OCBC's first-half wealth management income rose 27% to a record $3.29 billion. Assets under management in its banking business also increased 13% to $350 billion. This highlights an important trend for Singapore banks. As interest rates and lending margins come under pressure, wealth management, insurance, trading, and other fee-based businesses are becoming increasingly important sources of earnings. OCBC also raised its 2026 loan growth outlook. The bank now expects loan growth in the high single-digit to low double-digit range. That is an upgrade from its previous mid-single-digit forecast. However, there is still a major challenge. OCBC's net interest margin, or NIM, declined to 1.7% from 1.92% a year earlier. NIM is an important measure of how profitable a bank's lending business is. So, while lending margins are under pressure, OCBC is making up for some of that weakness through wealth management and other businesses. OCBC also increased its interim dividend. The dividend was raised to 47 Singapore cents per share, compared with 41 cents previously. Now, let's look at UOB. UOB reported second quarter net profit of 1.48 billion Singapore dollars. That was up 10% from $1.34 billion a year earlier. The result also beat analyst expectations. UOB's performance was again helped by wealth management. Net fee income increased 5% to $665 million. And wealth management income for the first half increased 16%. Growth across Malaysia, Indonesia, Thailand, and Vietnam was even stronger, at around 30%. UOB also increased its interim dividend. Shareholders will receive 88 Singapore cents per share, compared with 85 cents a year earlier. But there was one major concern. UOB lowered its 2026 forecast for fee income growth. The bank now expects fee income to grow at a low single-digit rate, compared with its previous high single-digit expectation. That change appears to have disappointed investors. UOB's shares fell as much as 2.7% during Friday trading. They eventually recovered some of the losses and closed at $43.30, down 0.6% for the day. OCBC had a very different reaction. Its shares climbed as much as 4% during the session and reached an all-time high of $30.50. OCBC eventually closed at $30.30, up 3.3%. So, why did investors favor OCBC? One reason is that OCBC delivered a much bigger earnings beat. Another is the stronger outlook for loan growth. And investors appear to be encouraged by the bank's ability to generate strong wealth management, insurance, and trading income while interest margins are falling. Analysts had already been positive on OCBC before these results. RHB had a buy rating and a target price of $29.80. DBS Research had a buy rating and a target price of $30. However, OCBC has now closed above both of those targets at $30.30. That means those existing targets imply roughly a 1 to 2% downside from the latest closing price. In other words, after the strong earnings reaction, OCBC is already trading above several recent analyst targets. There were also more bullish targets before the results. UOB K high-end had a target price of $31.60. Against the latest closing price of $30.30, That represents potential upside of about 4%. Now, let's look at UOB. Before the results, CGS International had a target price of $42.60. Against UOB's latest closing price of $43.30, that represents potential downside of around 2%. DBS Research was considerably more cautious, with a target price of $35.70. That would represent downside of roughly 18% from the latest price. So analyst views on UOB are much more divided. The key question is whether UOB's strong wealth management performance can continue to offset pressure from lower interest rates and slower fee income growth. There is another important point. Both OCBC and UOB reported lower net interest margins. OCBC's second quarter NIM fell to 1.7%. UOB's NIM fell to 1.74%. This tells us that the traditional banking business is facing pressure. But both banks are increasingly relying on wealth management and other fee-generating businesses to compensate. And this is not just a Singapore story. DBS, HSBC, and Standard Chartered have also been reporting strong wealth-related earnings. Singapore is becoming an increasingly important regional wealth management hub, and the banks are positioning themselves to benefit from this trend. There is also an interesting development around artificial intelligence. OCBC CEO Tan Teck Long said AI is already making a difference to the bank's wealth business. However, he also emphasized that the bank first looks at redesigning processes before deciding where AI should be used. In other words, the bank is not simply adopting AI for the sake of AI. It wants to make sure the technology is actually fit for purpose and creates value for customers and employees. So, what is the outlook for the two stocks? For OCBC, the investment case remains supported by strong wealth management growth, higher loan growth expectations, rising fee income, insurance earnings, and a higher dividend. But valuation is now an important consideration. After reaching a record high and closing at $30.30, OCBC has already moved above several analyst targets. That means future gains may require analysts to raise their targets following the strong second quarter results. For UOB, the situation is slightly different. The bank delivered a solid earnings beat and continues to benefit from strong wealth management growth and its regional ASEAN franchise. However, the lower fee income outlook is a warning sign. Investors will want to see whether UOB can maintain strong wealth management growth while improving its broader fee income performance. So, if we compare the two banks after their second quarter results, OCBC currently has the stronger earnings momentum. UOB, however, may offer a different opportunity if its share price weakness creates a more attractive valuation. The key risks for both banks remain lower interest rates, further pressure on net interest margins, weaker loan demand, market volatility, and potential deterioration in credit quality. On the positive side, continued wealth creation in Asia, stronger ASEAN economic activity, loan growth, and higher fee income could provide important earnings support. Our takeaway is this. OCBC delivered the more impressive second quarter result and received a much stronger share price reaction. UOB also delivered good results, but its reduced fee income guidance created more uncertainty for investors. For OCBC, the big question is whether earnings growth can justify the stock's record valuation. For UOB, the question is whether its wealth management and ASEAN businesses can offset slower fee income growth. And for both banks, wealth management could become an increasingly important growth engine as traditional lending margins remain under pressure. These are analyst estimates and market observations, not guaranteed future prices or investment advice. Always do your own research before buying or selling shares. If you enjoyed this video, please like, share, and subscribe to the channel for more Singapore business news, stock market updates, investing insights, and financial analysis. Thank you for watching.